law firms in Dublin. Now, I'm conscious it's early in the morning, and I'm feeling a bit like the graveyard slot, because I remember there's a partner of mine, and I was given a presentation one Friday around 4 o'clock, and he said to me, whatever you do, at least say one story, because if everyone forgets everything else in your presentation, hopefully they'll remember the story. By association, they'll remember you. So, and just back to BJ's point, probably about a year ago, we started discussing the platform, the Kenmare platform. And I suppose I really want to make the point, I would talk about the platform. And one of the conversations was around, and BJ and Brian and Dan were saying, well, actually, some of our clients are really interested in replicating Kenmare. And actually, they'd like their own structure, purely from a transparency perspective and from a ring fencing perspective. And so we said, great, we could have multiple SPVs, that sounds fantastic. As a lawyer, as an auditor as well, people say, whoa, that'd be great fees. And we said, no, we don't want something that expensive. Could we do something a little bit, that provides that, but at the same time, gives that security, gives that ring fencing, but isn't as, is cost effective. So that's where we came up with the concept of a corporate entity that's ring fenced. And it's segregated. What I mean by that is that it's essentially one corporate entity with a number of different cells to it. And it's bankruptcy remote as well. Now, really and the name that we came up for that, and I must give credit to both
Brian came up with it.
Brian came up with this. And I'll tell a story against myself, because I didn't recognize the name initially, but it was 10 o'clock on St. Patrick's Day when he told me.
That's right.
So he came up with a name which is Stag Fort, okay? And that's an old fort which is ring fenced down in Kerry on the west of Ireland. That's been around for about 2,000 years. And that's the name that we're using for the new entity. So basically, if we've got a fort that can stay around for 2,000 years, hopefully, that provides a ring fence protection. Hopefully, the new 110 structure will do the same. And basically, what that means is that because each cell is contractually ring fenced from each other cell, it's pretty much exactly the same as a separate company. What that means is that then you can follow the money in terms of from the settlement into the structure and down into with the trustee as well. Either that's going to RBC or that's going back as a loan. But I suppose that's the key point really, is that there is that transparency there. And one of my colleagues was in here this morning. He was formerly, until a few weeks ago, the General Counsel for the Central Bank of Ireland, who is an in-regulator in Ireland. And he tells quite a good story. Back in 2010, and so this is something you're quite familiar with, there was a bailout in Ireland. And so the Troika and IMF and so on in the EU are all here. And there's a number of conversations around looking at different pieces of legislation around, okay, well, what needs to go, what needs to stay? And clearly the key thing for Ireland was the 12.5% tax rate. That's why a number of people were in Ireland, the likes of Google and Facebook and so on. But the thing that didn't attract as much media was the securitization regime, or the 110 regime. And that was a key proponent of the Irish structure. That's why the likes of a Deutsche Bank are here, BNP are here, a number of the French banks, US banks. So whilst a number of other pieces of legislation were seen as being in some way more beneficial and had to be set aside under the bailout, the 12.5 regime and the 110 regime stayed. I suppose, and that's a key thing from a credibility perspective, that in our darkest hour, that's what we held on to. Mind you, we're all paying 55% income tax, that's different, but you're not paying that, so that's the key point. Now, John will talk to the transparency of the structure, I suppose, from what he's making the point in terms of withholding tax and tax within the structure. Doug asked a question last night to me. He said, well, if I'm going to give you guys $1 and I run $1 through the structure, are you telling me that take away costs and so on, that I'm going to get that $1 back again and any uplift? And John will go across that in terms of why there's no withholding tax, why there's no tax at the level of the structure itself, and why in terms of we can roll up your income and investments and that's paid back out again. I think from a credibility perspective, that's really important, because what you're trying to ensure is that you're getting both a mixture of an onshore, highly regulated jurisdiction, and which is ring fenced. Your investment within the platform, if you wish, is ring fenced from all other investments. But at the same time, there's no leakage. So it's not a case of, well, you can have all of this, but you're going to pay X% tax on that. So John will come on to that. And I suppose that's kind of the key thing. The other point is that in terms of the structure as well, and again, that was part of the conversations last night. So in terms of at our table, there was a conversation around, well, flexibility and something being bespoke. Because not all of you want the same structure. You may have, well, I want to invest this amount in capital, and actually I need X percentage of this back as a loan. I want this invested into different types of investments, and here's my investment strategy. So the key thing from our perspective is that it is bespoke. It's ring fenced, so it's ring fenced from all the liabilities, and it's an orphan entity, which means that it doesn't sit on a particular company's balance sheet. But the other point is that in terms of the documentation, that documentation is base documentation, but very easily we can address that so that it fits your needs and not our needs. Because sometimes I think in terms of investment that we all make, it's kind of a case of, well, here's our T's and C's, and that's just the way it is. That's not the case here.
Yeah, Anthony, let me just point out what he was just saying. Because with everybody in here, we're having different conversations about different types of investments with everybody, and what the Section 110 allows us to do, it allows us to move just a little past just the old, our traditional managed portfolio stuff with the RBC guys, which is will be a part of everybody's transaction, no matter how exotic it is. But these 110s now allow us to do some really cool stuff. Some of you guys have been talking about it, and Tor's
sharp.
Tor's going to speak to the tax liabilities. But that's an important point. The 110 now allows us to do just about anything. And many of you in here, we're talking about some really cool, different, interesting things. Now we can do it. This is like when you do a transaction now with the 110, this is like having your own fund, your own hedge fund or whatever. So just want to make that point.
Sure. John, do you want to take a second maybe? I'm just conscious of, I'm kind of talking about the whole tax and so on. Maybe that might be just a good point for maybe you to come in for a couple of minutes.
Right, thanks very much, Anthony. I have to say the conversation at our table wasn't so highbrow. We were talking about Joe, can I just actually go to the second last slide there in our presentation? So I might
Sure.
talk to this.
This one?
That one there, yeah.
Perfect.
So we're talking about Section 110s here, and the reason we're using this terminology, Section 110 is the specific tax code that this permits this vehicle to be set up. So it just shows that this is written into our tax legislation. So there's no great black box tax planning going on here. This is very clear and set out and agreed with the government. And what, at this most basic level, what the company does is allows you to roll up funds in the company. The company itself will pay what you'll see is 25% tax, which you might seem is quite high. But the way that this is written into legislation is that you can get an interest deduction from the company, and you can do it as a profit participating interest deduction. So effectively, whatever profit is made in the company, you can have a balancing figure that will remove that out and pay it out to the investor. And therefore, there's nothing left in the company to tax. And that's specifically written into the legislation. That payment out won't suffer any withholding tax. So as you're based in the US and you're in a treaty jurisdiction, which comes back to our point up here about tax treaty access, we have over 72 tax treaties around the jurisdiction, so both where the money is being invested into the company, but also out to you in the US, there's treaties there. And one of those is that there's no withholding tax. So we have transparent tax legislation. We have efficient profit extraction, that you effectively, the company's tax neutral. There's no thin capitalisation rules in Ireland. We have a wide treaty access. There's withholding tax exemptions which are written both in the treaties but also in our own domestic legislation. A lot of these services are VAT exempt, so it's not a cost to the company itself. As I mentioned earlier, there's no wealth tax. There's stamp duty exemptions, and you're taxed on your profit in the company with that sweet bake. So it makes a tax neutral company.
Yes.
That Section 110 regime has been agreed with the Irish Revenue. It has been tried and tested. It has been there for over 15 years. The Revenue are very familiar and actually encourage it and will sell it when they're abroad because we see it as attracting investments into Ireland and creating jobs in Ireland. So we're happy to have this regime in Ireland. So it is very flexible and you can do a number of things with it. And I think we've written a number of tax opinions on this and we've got very comfortable with the structure.
And that's an interesting point because each one that you guys will end up doing has its own opinion. So, I mean, that's how separate these things are, so.
Okay, perfect. Thanks, John. So,
Joe, do you want to say something?
No, I was just going to say, as it compares to the general taxation of Kenmare, in the U.S. there's something called economic performance. So if Kenmare were in the U.S. and it had income growth or investment growth of $100,000, but it also owed the attorney an additional $100,000 because the money is going to go to them eventually. They'd have income of $100,000, but they would not get the corresponding deduction of $100,000 until it was paid in the U.S. In Ireland, it's true accrual accounting in that those two are matched. Any increase in the value of the assets has a corresponding deduction because the money's going to be owed to the attorney. And that's why it works in Ireland, why there's no tax at the Kenmare level.
That's why we're here.
Right. So it's important to understand that difference. And I assume, so what you've said isn't in any way contrary or different through the 110 companies.
No, absolutely, and that's a key component of the
Right.
Section 110.
Right.
So maybe one of the follow-on points, and PJ made this earlier on, is that there's a very strong and local service team. And part of that is the day-to-day management control from an Irish perspective. John will talk to that. And you'll see that in John's opinions, is that it's an Irish incorporated entity, it's managed and controlled from here. I think this is nice. Sorry, I'm not trying to get at my own presentation by pulling other people into it, but I might pull Derek in at this point. It might be useful from a Centralis perspective just to hear around their role both as an administrator in terms of the preparation of the accounts, bank reconciliations, payments, and all those checks and balances, which Niamh obviously talked to in terms of the audit of that, but also maybe in terms of their role as a director on the platform as well, both from a Kenmare perspective in terms of new structure in terms of stag force as well. So maybe Derek, could you maybe just talk a few points around that?